All right. Welcome, everybody. Thanks for joining us. I'm Greg Reese, CEO and founder of AmeriEstate Legal Plan. With me today is the one, the only Shauna Wekherlien, known as the tax goddess. If you've tuned into some of our other webinars, Shauna and I have chatted on a number of occasions. She is one of the top 1% tax strategists in the nation. She's a CPA by training, but she has taken the time to do so much additional training that she's actually certified as what they call a tax specialist, which is really the top 1%. So let me just, before we cut into this, I just want you to understand, most CPAs are so burdened by the regulations of what's changing in the tax law that all they really have time to do is your tax returns. They're rarely ever anymore giving you tax advice and strategy and helping you to actually learn how to save money and to stretch your dollars further so that you can legally pay the minimum amount of tax that you should pay. This is the type of work that Shauna does. She's a tax strategist. Yes, she does your returns. However, she's going to try to save you a boatload of money because she is geared specifically to talk tax strategy to everybody. So we are fortunate and lucky to be able to avail ourselves of this tremendous talent so that she could give us some information here. We're coming up on the end of a tax year, right? 2022. However, a lot of what we'll talk about today will be applicable no matter what end of the tax year that we're talking about, right? So it's not just going to be like, okay, once the calendar clicks over again, none of this information is any good. Actually, a lot of this information will still be good. So we kind of want to talk today about a little bit of an intersection between estate planning and taxes, right? And also talk about what you might need or want to know coming into the last quarter of this year, because next year is when you file taxes for this year. Remember, I think most of you hopefully have already done your 2021 taxes. That should have been wrapped up about a month ago, I hope, for most of you. Some of us barely made it under the wire. But anyway, there's some important things that you might be able to glean from for the remainder of the year to help you when you do file your taxes next year. And then we also want to talk about the intersection of estate planning, because that's the focus of a lot of our clients. So with that being said, Shauna, welcome. Thank you for joining us.
Thank you so much for having me. I love being here with you guys, and especially talking my favorite subject, tax.
Yes, yes, and I learn something new every time we talk, so I love it too.
Aww.
So maybe we can just kind of take some high level stuff just regarding like the 2022 gift limitations and tax exemptions and things of that nature. Let's just start with, what are some of those highlights right now?
Some of the big numbers. So for a long time, there's two main numbers that people really want to know. There's the annual gifting limit, which for a long time was sitting at about 15,000. For 2022, it went up to 16,000. For 2023, it's going up to 17,000. Okay. And I'll explain why these numbers are important here in a second. So you have the annual gifting limit. So 16,000 this year in 2022, 17,000 next year in 2023. And we also have the lifetime gift and estate exemption. Was about, well, basically, long story short, 2023, it's going up to 12.92 million. Now, during the most recent, a couple of years ago, the political election, right? And we got President Biden. There were lots of discussions about that number coming down from 12 million something down to 1 million or 2 million or 3 million. So there were quite a lot of people that did a lot of detailed and in-depth estate planning at that time, because of course, everyone was very worried. Any money, any estate that you have above that lifetime exclusion, so in 2023, that'll be 12.92 million, any money or estate that you have above that will pay the estate tax on your death, which can be rather nasty. In the highest cases we've ever seen, it's about 63%. That's a lot of money to just lose, right, to taxes. So a lot of really heavy estate planning. Now, of course, we're going back into another political cycle. Aren't we always in a political cycle?
Always.
But always, this is something that has been looked at. This lifetime estate and gift tax limit has been looked at over and over and over again, because of course, from the government's perspective, well, we have a bunch of these millionaires who, millionaire is no longer a super wealthy thing right? I mean, I hate to phrase it that way, but you have a lot of people that are sitting on IRAs by themselves that are worth $600,000, $700,000, $800,000. Well, if you add the IRA, the 401k, the house, maybe your stocks that you have, you're already a millionaire. So the government is absolutely targeting anyone who is ultra wealthy, which at this point, the government has said that that ultra wealthy point is anyone with net worth over about $750,000. So the government is absolutely out to look for how can we get more money? How can we make more tax? What can we do with anyone who is ultra wealthy in this 750,000 net worth or higher? So the general commentary in the CPA world and the estate world is that they are going to continue to try to fight to get that estate tax limit back down to something they consider reasonable. So we do, as a CPA, we do still absolutely believe that estate and tax planning is super important, because what you don't want is to not plan, the estate limit drops, and now you're in deep trouble, right? So the government, the court cases and the government have said that as long as you do whatever estate planning you're going to do, while the limit is whatever it is, so at this point, 12.92 million for 2023, you are effectively grandfathered in. They don't expect to be going backwards and saying, well, we changed our minds retroactively, that limit will be 3 million. So now, even though you did planning when it was 12.92, it's really 3 million. So the good thing is if you're married, that 12.92 doubles, right? It's actually 2 people. So for a married couple, that is going to be a little over $25 million of tax-free income that you can pass on to heirs, to trusts, to charity if you want to, all of these other options. So it's really good numbers. I'm happy to see that number has increased instead of decreased this year. So
That's very true. And you know what, Shauna, you know me, I like to, each of our little topics, nuggets appear, and I like to dig a little bit deeper into some of these key things. And just to make a comment about the lifetime exemption of 12.92 million effective in 2023. There's always, it depends, there's always an it depends thing. If you do planning to kind of push some of that off through gifting, because we're talking about gifting and other things, then oftentimes they'll give us the grandfathering. But if they push the limit down in the future lower, and you still kept your 12.2, but you got rid of everything above 12.2, and they lower it down to 5 or something, then you might get credit for what you did, but you still are going to be over their little hog line. And sort of my little running joke about the estate tax and why it's always so contentious and why they're always trying to fight to lower it and so forth like that to raise more money for the government is because, folks, dead people don't vote, so they go after them.
Very evil,
right,
but true.
Okay.
Very true. Yes.
Segue. Let's go back to the annual gift tax limitation, which you said is $16,000 for 2022, and it's going to raise to $17,000. Who would take it? Typically, who would take advantage of that? And then we'll do the same thing for the annual lifetime exemption.
Absolutely. So who would take advantage of that? So let me back up. If you, as a person, can barely afford to feed your children, you're not going to be taking advantage of the gift limits. You're not even really looking at this in most instances. Okay. However, if you've got enough assets, you've looked at your own financial plan, right? And I know this can be a very subjective thing. Do I really feel like I have enough to be able to retire, pay for medical expenses, right? It's a guess. Who knows, right? It's the best guess that you can make. But for a lot of people, what they're looking at is they've got appreciating assets. So maybe let's say we've got a business, okay? And you know that you want to pass that business on to your children. One of the things you could consider doing is gifting non-controlling interest in that business to your children at the new pending $17,000 per year, right? You already know that this is what you want, that you want your business to be passed on to your kids. We see this a lot in real estate. Somebody's got a portfolio, 5 rentals, 10 rentals, 100 rentals, right? They know that they want those assets to pass on to their kids, not be sold off to pay a tax bill, right? You can start to gift little bits, a percentage interest in a family limited partnership that owns the real estate. You can start to gift these things to kids. You can start to gift them to grandkids. The cool thing about the gifting limit The gift does not have to be family, like a direct, like a child or a parent. A gift can go to anyone. So I could give you, Greg, $17,000 if I wanted to.
I wondered when you were getting to that.
Tomorrow, Greg, you'll have that check.
Tomorrow.
Tomorrow. But yes, you can absolutely give gift cash, right? So some of our parents, what they will do, and this will be one of the tax strategies we're going to talk about, but some of our parents will gift cash to the kids that are in college, right? To help them pay for room and board or help them pay for college so they don't have student loans. On the other side of that tax strategy, you could pay your kids and get a much better deduction for that, but we'll get to that. So, the gifting, that $17,000 can really be used all over the place. It can also be used, we often see it as well with parents, okay? So let's say your parents are getting older, they need some medical attention, maybe one of them or both of them need to go into a medical care facility, okay? But they don't have any assets. Sometimes if the parents have no assets, they can get state help, they can get additional funding, they can get discounts on going into facilities, right? So sometimes you want the parents to gift assets, get the assets out of their name, right? So that they can get this additional help. Sometimes it's the other way around. The kids have made a lot of money, they've done really well, and they have money to be able to support the parents. The kids might be able to gift an asset to the parents. So let's say, for example, a company vehicle, and the kids can pay the parents every single month a lease, they can pay money to actually now get cash to the parents. So there's all sorts of cool tax strategies that use this gifting idea as a way to move assets around between family, between business partners, parents and children, vice versa, children to parents, either direction, to be able to move assets not only to escape estate taxes, potentially whenever that happens down the road, but also for actual current year tax planning impacts to get better deductions to lower your overall taxation. So.
Perfect. So that's a lot of reasons why, and that's very in-depth. Thank you. And then it's probably not as many reasons, but on the other end, like the lifetime exemptions when I'm over this limit. Oh, and the other thing I want to ask you about is, because as you mentioned, Congress is always fighting about, do we keep it where it is? Do we allow it to grow by some inflation factor? Or do we want to reset the law at a lower number so we can theoretically collect more tax? But isn't it true that the current law has a sunset provision that might expire on its own if Congress doesn't actually act to do something or extend it? What's that about?
Absolutely. So what's that about? Welcome to politics, right? That's what that's about. The very long story short is many politicians have to balance what their constituents think versus what they and the people that have money want, right? This is a balancing act. So in many laws that get put into place, a sunset provision gets added. And it basically says at X year, at the end of X year, this law that we've put into place is now going to disappear. And it's going to retroactively go back to, so for example, at the end of 2025, the estate tax exemption is going to drop from whatever 12.92 million back down to 3. Okay, now there becomes a really big question here. And this is one of those things where who knows? Okay, we have seen since 1986, okay, the use of sunset provisions has come in very, very frequently. It's become a very popular mechanism in the political world. But to be honest with you, when the taxpayers like it, it's very hard for a politician not to say, well, we're just going to kick that can down the road. We're going to update that sunset provision and we're going to push it out another 4 years or another 5 years or another 10 years, whatever it is, right? So we just saw that with COVID, right? There were a lot of rules that were supposed to expire on December 31st of 2020, but because we were in the middle of COVID, all of those rules got expanded. Now they're all pushed out to 2026. So you are absolutely correct. There is a sunset provision on these current super high gift and estate tax limits. And the real question is, do we think they're actually going to do it? Like it's almost like playing a game of chicken with the politics. So, Greg, going back to one of the things that you said very early in the conversation, if you're going to do planning, okay, so let me back up. If your current estate is worth $1 million, Do I personally feel like you need to do big estate plans worth $25 million? I mean, only unless you know you're going to win the lottery, in which case share those numbers, right? I think it's $1 billion right now, like share the numbers. But if your current estate is $1 million, you should at a very bare minimum be doing the bare minimum, right? You should have a revocable trust. Anytime your net worth is more than about 250,000, or if you have kids, you need the basics, period, right? You need a revocable trust. You need medical powers of attorney. I'm sure Greg would know a lot more about this than I would, but there's kind of these basics, okay? So if your estate's at $1 million, you absolutely should already have these basics. If your estate is sitting, if you're married and your estate's sitting at 5 million, that's what they're talking about, this sunsetting, right? You really, really ought to be looking at something a little bit above the basics, maybe some gifting programs. Do we want to do charity? Like, start looking at this stuff, right? We hope that you're going to have more time. But one of my favorite business coaches ever taught me, hope is not a strategy.
Hope is not a strategy.
Not a strategy. So absolutely, if you know that you're going to pass that business on to the kids, if you know that you're going to pass the real estate on to the kids, if you already know these things, there are specific ways to pass on assets where you still maintain control, but they're not necessarily a part of your estate. So again, a very common example is a family limited partnership, okay? You might own the 1% general partner, so you make all the decisions, but 99% of the value of the assets is owned by your kids and your grandkids. So there's some really cool planning that you can do, because control seems to come up a lot when we're discussing this type of stuff with clients. They're nervous, right? Well, what if something happens to me and I need that money for medical expenses, or, I want to go on a trip around the world as my final thing before I die, or whatever it is, right? People like control. They want control over their money. So finding that perfect combination between control and yet also planning is super important. And, that's why we have the experts like you, Greg, right? To help us maneuver through those things.
Thank you. Well, and thank God we have experts like you, because, hope is not a strategy, and you need to have execution, and you need to know what to do. I'd like to take a quick opportunity to remind everybody that's watching that we do have a chat feature. You can ask questions. And I think if I see a question pop up that I think is super relevant to what we're talking about at the moment, we'll address it. I'll ask Shauna, but at the end we kind of address whatever we have time for. So one came up that I think is perfect, and it will serve as a segue to the next question. Somebody's asking, is annual gifting included in the $12 million lifetime cap?
It is not, which is super awesome from my standpoint, right? That 12.92, right? When that number gets up in 2023, or right now it's 12.06 for 2022, it's 12.06. So the $12 million lifetime cap does not include annual gifting, okay? The only time that annual gifting applies to that lifetime cap is if you go over. So let me give you a couple of examples where the IRS has really kind of nailed people for this, okay? So let's talk 2022. The annual gifting limit is $16,000, okay? So you write a check to your child, right? Here's your $16,000 gift. The IRS has nailed people for giving birthday presents and Christmas presents, okay? Because a birthday present has value, right? You bought that Apple phone and it was $1,000. Well, guess what? You didn't give the child 16, you gave them 17. That $1,000 difference, that Christmas gift that you gave that child, now comes out of your lifetime cap, okay? So the real question here, when we're talking about that lifetime cap, versus the annual gifting. First things first, if you're going to give annual gifts, great. Make sure you keep a record of any gift that you give to that person, especially children, right? That's where the IRS really looks, okay? And especially now that we have that huge $43 million budget and we're going to get 87,000 new agents, they're all out looking for stuff to do, right? So super, super handy from that standpoint.
That's
so
true.
I would suggest keep a spreadsheet. Who are you gifting? When did you give it? What did you give them? What was the approximate value? Like maybe you gave some heirloom jewelry from your grandmother and you're giving it to your child. What was that value, right? So spreadsheets are good from that standpoint. And then the second thing that you can do to really protect your lifetime number, whatever the lifetime number is especially if you have enough where you need to get that out of your estate now, get a certified valuation for whatever it is you're giving. Okay, so if you're giving away a portion of the business, get a certified valuation. What is the value of the business on the day you gifted it? We had a client, for example, that oh, this makes me smile, but $5,000 of Ethereum the day Ethereum came out, and is now sitting on $120 million worth of cash, basically, right? And so he is starting to go through these types of questions. And what do I want to do, right? Because obviously he's going to bypass his lifetime limit really, really quickly. What else does he want to do? Does he want to do charity? Does he want to create a foundation? Does he want to spend it now? Can we set up a business? Like, what other things can we do to either bring the estate down or understand that a portion will get paid to the government? So,
Perfect.
great
And
question.
then just a related question, Shauna. Somebody is asking, if I gift $16,000 to a friend, which just illustrates you can give to anybody you want. Parents and child, parents can both gift to a child, so 16 and 16, don't forget that. Who wants to know if he gave $16,000 to a friend, would that friend have to pay taxes on it?
No, this is the cool, well, it's the good and the bad of a gift, right? Your friend does not have to pay tax on it, but you also do not get the tax deduction. So it's a gift both ways from that standpoint. It's literally, here's some money, we're done, that's the end of the conversation.
Perfect, good. So that's some good. So folks, bring your questions on. If we're talking about that, we'll try to bring them up while we're there. So I think we're kind of leaning right into some strategies to save money on taxes now. Is there anything that people should be paying attention to kind of in the final quarter of the year? And it just as a general tax strategy idea.
Absolutely. Well, you're getting on my favorite subject, Greg, all the good bits. So you better stop me when I start talking too much.
I know. Well, I know she's going to have to start charging in a minute here, but we're going to get as much out of her as we can for your benefit.
My absolute favorite strategy, and has been and always will be, is if you don't have a business, you need a business. Okay. Now, I get asked this question all the time. Well, Shauna, I'm in a business. Doesn't that mean I need staff and employees and a whole bunch of customers? Guys, I am literally talking about go drive for Lyft or Uber for a couple of days, maybe one day a week, get a side gig, get some sort of income that is not primary, like from your W-2 job, okay? Once you have a business, now a whole world of opportunity opens up for tax strategy, okay? Now, there are some tax strategies that are W-2. So if you're listening and you're a W-2 person only, I want you to go be looking at oil and gas investments. Okay, there's some great tax strategies there. Solar credits, there's some, and I mean like investing in a solar farm or buying solar credits for a business or a building. Those kinds of things are super duper helpful. There are some really cool things that you can do with life insurance. So if you're healthy, you can really build some value, borrow money to then go buy businesses or whatever else you want to do. Those are really for our W-2 folks. If you've got a business, I'm going to give you my top three, my favorite top three. So I hope you guys love this. Okay. The first one is paying your kids. Now, I know we're talking about gifting money to children, and that's fine, right? But remember I said, if you gift it, you do not get a tax deduction. Okay. If you have a business and you pay your children, actually W-2, pay your children, this year, 2022, the maximum that you can pay a child, you have no tax, and the child has no tax, is $19,500 per child, okay, 19,500. So if you've got a household of 3 children, right, times 19,500, that's $58,000, 58,500, that is completely tax-free to both you and the kids, okay? And you can use the money that you paid the kids either to invest, right? Right now the market is tanking, right? You can go buy them some Google and let them sit on it for the next 20 years, right? Hopefully that price will come way up. Or you can use that cash to pay for anything that is not a primary duty of a parent. And a primary duty is food, clothing, or shelter, okay? So you can give that money to the kids, pay that money to the kids. They can use it to pay for karate lessons, music lessons, summer camp, daycare, nannies, right? Anything other than food, clothing, or shelter. So one of my favorite clients has 10 children, and all of them are effectively on the payroll. So she is not 19,500 times 10 kids their family is not paying tax on $195,000 a year. Okay. I'm certainly not saying go have 10 children. Okay. But if you've got one, it's still almost 20 grand. That's not taxable. Okay.
How old does the child need to be able to pay them?
Ooh, so we just got some new rules on this, Greg. I love it. It depends.
I'm taking notes here because I got two.
You got what? You got one in college, don't you?
I got one in college too.
There we go. It's very expensive. Okay. There are two separate types of job duties that a child can do. So the normal, and this works for parents and for grandparents. Okay. So it's got to be lineal. It can't be your neighbor's kid. It doesn't work with somebody outside the family. It's got to be lineal family here. Okay. Starting at 7 years old, they are allowed to work for you. Now, work from this definition means shred, sweep the floors, vacuum, put away files, move boxes, like whatever it is in your business, a physical job that they're going to do. Okay. But new court cases just came out that your child can be paid if they're less than 7, if your business needs some sort of photographic model. So for example, if you sell baby strollers and your baby is in the picture in the baby strollers, you can now pay the child as a child model. So we have a lot of parents with kids that are younger than 7 that are going the child model route. Like for example, if you're a real estate agent, have the kid on the lawn in front of the house to show this is a family home. Okay, children models. This is really cool. Child models, the current average in the US is $75,000 per child. So if you had 2 babies, a 2-year-old and a 3-year-old, and you decide to put them both in the modeling picture, you're talking $150,000 worth of tax-free income to the parents, right? The kids will have to pay tax, but it's at a much lower rate. So if the parents are at 37%, kids might be at 10 or 15%, you're still getting all the savings on the spread. Super cool.
That is pretty interesting. That is pretty interesting. I'm taking good notes on that. So, yeah, that's something very, what about people that own investment real estate? Can they create an entity like an LLC around that, and then that's their business?
You got it.
It doesn't have to be a side gig like an Uber or delivery or something.
Any kind of business you want. It could be selling something on Etsy. It could absolutely, if you have rental properties, you could create a management company and have your kids go with you to the property and sweep the floor or check the plumbing or, whatever, right? Whatever the kids can actually do. So with a lot of our parents, especially when the kids start getting to 12, 14, one in college, these kinds of things, you can actually pay the child the fair market value of whatever the rate is that you would pay another professional to do that job. So with our 12, 14, 16, 18, a lot of our parents are going the route of having the kid run the Facebook, Twitter, TikTok, YouTube channels, right? Because they know a lot more about that than all us old people do, right? About how to run that stuff. And a manager, a social media manager, is currently being paid $120 an hour for that work. So significant amounts of money. If you've got a kid in college who's running your Facebook page on the side, they can earn their $45,000 worth of college expenses or whatever. You get a tax deduction, everybody's happy. So.
Oh, very interesting. Very interesting. So we'll have to chat offline a little bit about that college kid. There's the 529 money, but most of that's really going to the core educational stuff, but there's other stuff, transportation and all this other fun stuff.
Well, and you see so many parents paying for the cell phone and paying for the car insurance, and all of this money is coming out of the personal pocket. You're not getting a tax deduction. Why would we not try to figure out how to make the same money you're already spending, make it a tax deduction? So. Yeah,
no, you hear that, folks? I mean, the world is your oyster. There's so many things you can think of that you spend money on for your kids that actually you can incentivize them to, take out the trash, sweep the floor, do some things, help cover their transportation costs, when they get a little bit older and they're driving, and gas, insurance, everything, I can just think of a dozen things off the top of my head. So that's awesome. Is there any conversation that needs to be had, do you think, on kind of the direction of marginal income tax rates or brackets or deductions, or how do people manage that kind of stuff? Or is there much that they can do other than some of your top 3 and other thoughts?
Absolutely. Is there much you can do? Well, let me come back to this question. The rates are the rates are the rates. So I'm laying that as a baseline. Okay. If you are a straight up W-2, That's all you have. Husband, wife, both W-2s, you have a home mortgage. To be honest with you, there's not a whole lot you can do. It just kind of is what it is. I mean, you could maximize like interior to your company. You could maximize 401k, you could max your HSA, you could max, maybe if there's an FSA, if there's any kinds of programs interior to your company's W-2, you can do that, okay? But I come back to the premise, right? Owning a business, any kind of business, side gig, anything, make a business for your children, right? Any kind of side business, because of course, my number one strategy is pay the kids. But if you own a business, you can also use the master's exemption, right? Which means that you can rent your home to your business. For most people, that works out to somewhere between $40,000 and $100,000 worth of tax-free income every year. So if we've got the kids at 50 grand, the master's exemption at 100 grand, right? That's 150,000 off the top of your W-2 every year. Huge benefit, right? The third one that I just want to squeak in there really quickly, if you're going to buy a car, I just have to say this and then I'll drop the subject, but 2022, there are two types of tax codes under which you can buy a vehicle for business purposes. Okay, one is 179, the other one is 168K. Now, the only reason I bring this up right now, we have 2 months until the end of this year. Okay, if you own a business, so you got to own a business. Okay, the vehicle has to be for business purposes. And from my perspective as a professional, you absolutely want to make sure that your business vehicle is used for business, right? Used for business. So if you're buying a vehicle for personal purposes, this is not really going to help you, okay? But if you're buying a business vehicle that on the very last day, on December 31st, Greg, you drive around your city and you go visit all your clients and you bought that car on December 31st, it's 100% business use, okay? We want 100%. Yeah, we want 100% business use for the time in the year when you own that car. If you use section 168K, okay, and it only qualifies for 2022 with what I'm about to say, which is why I'm bringing it up now, okay? Because normally I'm not a big fan of buying a car just to get a tax deduction, but if you need a car, this is the time to go look, okay? If you use 168K, even if your business is already at a loss, you can make your business a bigger loss by buying the right type of car, more than 6,000 pounds, seats like cargo vans, these kinds of things. There's some specific requirements. And if we have time, I'll go into those. But making sure that you buy that car with 179. So for all of those, I see some comments about talking to your CPA, this kind of thing. Make sure your CPA is using 168K, not 179. If you use 179, you can only take a deduction if your company has a profit. My job is to give you strategies to help your business create a loss to offset other income, right? Either offset your business income, offset W-2 income, offset rental income, offset income from your DST, okay? From whatever you've sold. If you can get a loss, those losses will offset all this other income. So the 168K, the reason why I'm bringing this up before December 31st, the 168K will reduce from 100% allowable to 80% allowable on January 1st. So if you're going to buy a car, you need it for business purposes, okay? It's more than 6,000 pounds. Buy it, get it sold, and drive it at least one day, December 31st for this year, and you can take a 100% write-off against any of your other income. Good stuff.
Yep, and that's Shauna, I'm looking at some of the questions coming up. You struck a vein with your creative business suggestion and bring your kids in. So a lot of interest is popping up on that. Quick, and I'll just try to get to some of the highlights here. If you do this and you employ your child, do you 1099 them or you W-2 them, or is there a break point where you can 1099 if this is all they're going to do, but if you're going to do more, then maybe it has to be 1099? What's that look like?
Absolutely. If it's less than $600, 1099. Okay, so it's $599 or less, 1099. If it's more, which if you're going to shoot for that 19.5, if you're going to shoot for those higher numbers, it should be absolutely.
Yeah. Doesn't that the kid have to be a certain age to pay their own tax bracket, which is like lower than yours?
Well, this is because what you're talking about is earned income versus unearned income, right? If it's unearned income, like interest or dividends, there's no benefit here. because the kid's going to pay at your tax rate because it's unearned income. With earned income, there is no such distinction.
Okay.
So I've got one parent, for example, whose daughter is into a very expensive habit called horse riding. He is paying her $120,000 a year for some social media management, right? Some modeling and some of these other jobs. Okay. That $120,000 is paying for her, it's her choice, it's her money, right? It's paying for her hobby to go do her horse riding. But the father is getting $120,000 write-off. She's not, she's paying tax, but not nearly as much tax as he was paying. He's in the maximum 63% bracket. She's basically at about 20. Huge difference. So.
Yeah, that's awesome. Somebody asked if there's any specific tax strategies for retired individuals that we haven't mentioned.
Absolutely. Yeah. So some of the big ones, I already mentioned oil and gas. So if you're looking for any additional investments, the one thing I like about oil and gas is absolutely an investment. Okay. But generally in the first year, you're going to get a 92% deduction of whatever you invested into the oil and gas. Okay. So if you need a one-time, if you've had a big pullout of money or something that's going to be taxable and you need a one-time offset to that, you can absolutely look at oil and gas. You could look at your RMDs. So generally, once you hit retirement, you might be looking at an RMD, required minimum distribution. If you're charitable minded, instead of taking the RMD, you can actually direct the RMD towards charity directly. It's called a QCD, qualified charitable distribution. This would allow you to take up to $100,000 of your RMD, your required minimum distribution, not pay tax on it, and give that money directly to a charity. So that's something to look at. I'm smiling because if you're retired, you may have grandchildren. So set up a business for the grandkids.
Yeah,
but
anybody can do it, right?
Anybody can do it. Anybody can do it. Instead of a lawn mowing business for the kids, there we go. The other thing I like to bring up sometimes, not always, but sometimes in retirement, you have done such a good job of planning early that your taxable income now in retirement is low. You may want to look into, is it a good time to do some conversions? Do you have some money that is currently traditional, but you don't have a lot of Roth? Is it time to maybe do some Roth conversions? Pay a little bit of tax now, but then you have complete freedom. You do not have to take RMDs. There's all sorts of benefits to having some Roth. So that's something to look at. You could move out of the country. Move out of the state. You could move to Florida or Texas, at least get rid of some state taxes. You could move to Costa Rica, Belize, any earned income, you'd have $120,000 not taxable from that standpoint. So I guess in my world, the real answer to your question, Greg, is that every single person's plan, when we talk about tax planning, every single person's plan is so customized to them, to what they have and what they want and what they're looking for. Some people are really heavy into charities. Some people want to travel the globe on a boat. Some people just want to pay for college for their grandkids. We really try to look at each and every custom person, because every single strategy, I can give you all the strategies, but how do you, as a listener today, how do you know which ones are going to be best for you in your situation? So.
Perfect. So just a quick recap, then I want to switch over to, in the time remaining, to some estate planning related applications. But somebody was asking if for the kids, if it's over 600, then what? I think you can 1099 somebody if all you plan to pay them is no more than $600 in the year. But if you plan to pay them more than $600 for the whole year, and it could be their Easter break, summer break, Christmas break, whatever, it's going to be more than $600. At the end of the year, you're going to want to W-2 them. You'll get a deduction either way, but that's the best way to go about it. The 170, the 168, and the 179 deduction for a car, does under both sections, does the car have to be more than 6,000 pounds and meet those requirements?
Yes, in order to write off the car, the full purchase price of the car, it has to be 6,000 pounds or more. Now, they did just modify this a little bit. It used to be curb weight, so 6,000 pounds curb weight. They have just, like 2 weeks ago, just changed this. It's now 6,000 pounds fully loaded weight. So for example, the new Plaid, the new electric vehicle Plaid, the electric vehicle is tiny, but loaded weight is more than 6,000 pounds. So not only do you get the electric vehicle credit, but you also can take the 100% deduction. So it's pretty.
Wow, I thought load weight, you were talking about when I had sit in the car. That's load weight. Yeah.
Yeah, with fully
That adds
loaded, it's
another
the
350
people.
pounds right there.
You're too funny, Greg. It's fully
That's not
loaded
what
with
you're talking about.
people, equipment. Under the new law, that is what I'm talking about. Under the old law, it was only the car itself, right? Under
That's
the
brilliant.
new, yes,
That's brilliant.
yes.
Because I bought, I bought a GMC Acadia a few years ago in my business. It was over 6,000 pounds. Some of the SUVs, and I needed one for business because I got to haul stuff here and there from time to time. And that qualified. It was great. But now it's load weight. So
Load weight.
maybe there's a vehicle that's a little bit less than that curb weight, but the
Yep.
load weight you get to add to it, that's a very interesting little differentiation. Okay, perfect. All right, time remaining. A couple things regarding taxes, the intersection of taxes and estate planning. Common question, get it all the time. Is inheritance received from a parent or a grandparent or somebody else received by you, is it taxable to you? And if not, are there forms of inheritance that are taxable?
Well, I'm going to answer the first question first, which is an inheritance taxable? 99.99% of the time, no, because the person receiving the money, now taxable, right? That's the question. Is the person receiving the money, is it taxable to them? No. The person who had the money, who is now deceased, it would be taxable if it was above that estate tax limit, it would be taxable to the estate. So there is tax paid if it's above those limits, but it's not the person receiving it, it's the person who had it originally. It's the estate of the person who had it.
So 99% of recipients, your inheritance is not taxable.
Agreed.
But
Agreed.
there may be a couple exceptions to that. But what are those?
It depends. We have seen cases where the IRS will go after the person receiving the money because the estate, the trustee didn't do it right. Okay, so maybe you got your money, but now the IRS is coming after you for payments. So they're very, very rare. Really, I wouldn't worry about them.
I'm thinking more like IRAs, annuities, stuff like that.
Your distribution. Nice. Yeah. The rollover of the distribution. So well, Greg, why don't we talk about it?
Well, if you want me to, I can. But that would be more the former financial advisor in me. So, yeah, inheritance generally is 100% tax free to you as the recipient. However, your parents, for example, who may be leaving the inheritance to you, they may have in their financial estate certain assets such as their IRAs and 401k plans. They may have tax deferred annuities as two common primary major examples. Those become taxable when the funds are withdrawn from those accounts. So while you do escape inheritance taxes and you're not taxed just because I inherited an IRA or I inherited an annuity, but when I draw money from those accounts, and it could be 5 or 10 years down the road, don't get me wrong, I'll have to pay tax on the money I take in a given year, not directly when I get it. If I got this annuity account, if I don't cash it out and take the money, I don't pay tax until I do. If I inherited the IRA, I don't pay tax on the IRA unless and until I start drawing from it. So I think that's a distinction that a lot of people wanted to know, but largely 99.9% of the time, there is no tax for receiving inheritance. Now, Shauna hit on some of the basic foundations that everybody needs to have. You should have, if you own a home or you've got at least $250,000 in gross assets, just as a general rule of thumb, you should have the basics: a revocable living trust. You should have durable powers of attorney. You should have healthcare directives and things of that nature. Because if you don't, there's another hidden tax that a lot of people don't think about, and by the time they could think about it, it's too late for them, which is called probate. Probate is the process of settling and distributing your estate and paying all your bills and taxes and all that kind of stuff when you die, if you haven't done that basic planning. So now instead of you having a trust set up that says, here's what I want to happen, here's who's in charge of it, make it so. You administer it, you give everybody what I want them to have written out in this trust document. If you don't have that, then everything you own goes into the court process called probate, and a judge and others sort it out, and they charge pretty big fees. And so probate becomes a tax that you can easily avoid by having an estate plan in place. Am I right?
Absolutely, 100%. Yeah.
Okay.
And I
And
think that's a
so,
big piece of it. And I'm so sorry to interrupt there. I'm even seeing some questions in here, guys. Whenever you're making any kind of move, you want to have your financial team involved, right? Your trust attorney, you want to have your financial advisor, you want to have your CPA, you want to have your tax strategist, right? You want to have all of those people involved in making decisions and in these types of things. Because to be honest with you, I'm sure Greg can say the same thing. I have seen cases where somebody did something, oh, my neighbor told me to do this and he said it was a good idea. Problem is, his case is different than your case. And when you do it, now it causes a penalty. Now it causes some sort of issue. Now it causes whatever it is, right? So no matter what you decide to do, I would highly recommend that you get your professional team involved in all of those discussions. So yeah, Greg, perfect.
right. Okay. Now some folks are kind of digging into maybe some state specific stuff, but keeping in mind that with the trust or without a trust, if there's inheritance tax, you're still going to have to pay the tax. But the hog line is pretty high up there, so vast majority of us don't typically have to deal with that. There are still a few states that impose their own separate inheritance tax, so you got to be mindful of some of those states that you might live in, and that might trigger you to move to Texas, Florida, or Nevada, or some of these other states if that's the case and you have a fairly large estate. Somebody's asking a little bit about California, Prop 19. Prop 19 kind of is and I have a pretty deep memo on Prop 19. So if anybody really is interested and you want to email us, Greg at AmeriEstate.com or Caroline at AmeriEstate.com. She handles a lot of our coordination of the webinars that we do. We can send you that memo, but effectively it kind of replaced most of Prop 19, which allowed you to keep your property tax basis low while you own your home, and also transfer that low property tax basis down to your children when they inherit real property from you. Now they've added some restrictions that can only apply to the family personal residence, and the kid has to live in the property, within a year of your passing for you to keep their low property tax basis. What if you have, and this is a bigger question than we have time for today. What if there are multiple beneficiaries and you just listed them in your trust for a percentage, like 4 kids, 25% each or something like that? You didn't specify that one of the kids is going to get the house as part of their 25% share. Part of the problem sometimes is the house is more than, the equitable share that one child would inherit. How do we deal with that and still preserve the quote Prop 13? We handle that on a routine basis over here. It's fairly complicated and in depth, and not many people actually know how to do this and how this works. But that is a key question that comes up a lot. So I would invite you to reach back out to our office, more directly for a consult on that if you're staring at that, or that's coming up, or you're worried about your parents and how their estate is organized, because somebody desperately would love to, live, keep, and maintain that property, while the other beneficiaries still get what they're entitled to. There's a way to accomplish that, and you'd be pleasantly surprised. So let me just see really quick, Shauna, if there's any other key questions that we can answer for folks, but I know we're running out of time here.
I was trying to be good and answer people's questions in the chat boxes on the side. Yeah. One of the biggest things, as we both said, find your professional team. One of the questions that had come up, well, how do I find the professional team? How do I know that the person that I'm working with is good, right? And I gave one answer specifically for real estate. I think that the biggest thing here is when you're interviewing for any professional, make sure that you're not only interviewing for technical skill, right? So for example, the question that was asked was specifically about real estate and, rental properties and this kind of thing. Make sure the CPA that you're talking to knows what cost segregation is and can explain that to you, because that's a huge concept in real estate. If they don't know that right away, go find somebody else, okay? But the second question, at least from my perspective, when trying to find the team, many of you, if you've ever worked with a financial advisor, the financial advisor will ask you, well, how aggressive do you want to be? Conservative, aggressive, where do you want your portfolio to be? The same question applies to effectively any other professional you work with. So for example, in my industry, right, 0 to 10, I always phrase it this way, there's a scale of aggression for tax strategy. you need to know where you sit on this scale so that the team that you're working with matches your scale where you are. So the way I always phrase it is 0 to 10. 0 means you're leaving money on the table, but the IRS will never, never, ever call you. 10 mean we're all going to jail, right? Where do you, as a person, where do you want to sit with your tax strategies? Where do you want to sit with your trust strategy, right? Where do you want to sit for these things? So if you are a level 2, then you need to find an advisory team that is also about that 2 or 3 level, right? For most of our clients, we deal almost exclusively with business owners, cryptocurrency, real estate, these types of things. Most of the people that contact us, they're level 8. I want to keep all of my money. I don't want to do anything illegal. Not going to jail. Neither do I, right? Red and orange do not look good together, okay? But they want to keep every penny they possibly can legally, right? So if you're an 8 listening to this and your CPA is a 2, you might need to find a level 8 CPA, right? You got to have a team that ties in with your aggression scale. Because if you're an 8 and their CPA is a 2 and they're giving you level 2 strategies, how much money are you leaving on the table for the IRS? How much money are you going to hand over because your trust and estate plan was not up to date to the government just because your advisor was a level 2 and you were a level 8? So for me, it's super important.
That's a great, I think that's a great wrap up point, because I think we started about talking about how a lot of CPAs don't really engage much in strategy. And it's not because maybe they can't do it. It's just the time burden is such that they have more tax prep clients than they do strategy clients, and that's where their time goes. Only so many hours in the day. So so think about that, folks. I mean, you can always get some good information by listening to these blogs and reaching out and asking some questions. And if we can help you, we certainly will. If we need to help find a solution for you, even if it's somebody else, we're happy to try to do that for you, because you need to be matched up with what you're about and where you sit on that line. So with that, Shauna, I think we've taken way more time than I thought we were going to today. I hope everybody enjoyed this, and I want to really thank you again for all the time that you've taken. I know how busy you are. So thank you. And anybody else that has questions, just send them through the chat or email us. We'll circulate them around for answers, and we'll do this again. We'll do this again.
Can you just repeat my email? They can email me directly and we can get the questions answered for them.
Caroline is asking for us to give you her direct email address so that she can take charge of all of those answers and routing for the right results. Caroline at AmeriEstate.com. CAROLINE at AmeriEstate.com. AmeriEstate.com.
Great. And we'll get to the questions.
And we'll get to the questions that maybe did get answered today, maybe circulate some answers back to you. But thank you again, Shauna. Thank you, everybody, for joining us. It's been a pleasure. Now go out there and save money on some taxes. Okay, don't ignore this sign behind my head. Don't pay your taxes now here. Find a way to do it legally the opposite direction. Okay, with that, I think we're out. Thank you, Shauna.
Well, have a great day. Bye.
All right, you too. Bye-bye.
Oh my gosh, getting a lot of thumbs up and